I want to start today with a question that feels really simple at first, but the more you actually chew on it, the more uncomfortable it gets.
Oh, I know where you're going with this.
Right. Because when you look at your retirement account, your 401k, or just how the entire global financial system is wired, what is the one basic rule that decides where all that money goes?
If you are investing like most of the planet, meaning, you're buying the big indices like the S&P 500, the rule is size, strictly size.
Size. So
Yeah.
the bigger the company, the more of my paycheck it automatically gets.
It's basically a popularity contest. It's what we call market cap weighting. If a company doubles in value, the index automatically buys more of it, and if it shrinks, the index sells it.
It's just a momentum machine.
Exactly, a pure momentum machine.
Which, I mean, to play devil's advocate here for a second, that makes sense, right? You want to bet on the winners. If a company is huge, they must be doing something right. Why would I want to bet on the losers?
It feels safe. It definitely feels logical. But we are doing a deep dive today into a stack of research that suggests this entire model might actually be biologically backward.
Biologically.
Yeah, we are looking at this really fascinating synthesis of finance and evolutionary biology. It draws heavily on Matt Ridley's book, How Innovation Works, and some deep research into what's called inside ownership.
Okay, so wait. Biologically backward. What does that mean for my money?
The core argument is that standard indices like the S&P 500 are designed like a centralized bureaucracy. They're very top-down.
Yeah.
But the actual drivers of wealth creation, the real engines of the economy, they look a lot more like a jungle. They follow the brutal rules of evolution.
So we're basically pitting Wall Street against Darwin today.
In a way, yes. We're exploring why an index that is weighted by inside ownership, meaning the founders and executives still hold massive personal stakes in the business, why that might completely crush traditional investing.
And not just because the math is clever, but
Because the biology is better.
Yes. Okay, I'm totally hooked. Let's start with the biology part. Ridley's book is the foundation here. And when I think of some CEO in a suit trying to hit a quarterly earnings target, I don't necessarily picture a lizard trying to survive in the desert. How do we bridge that gap?
It really comes down to how you define progress. We all have this kind of great man theory of history in our heads.
Sure, the lone genius.
Right. We think progress comes from a visionary like Steve Jobs sitting in a glass tower, sketching out the iPhone from scratch, entirely top down.
And Ridley says that's not how it works.
Ridley says that is mostly a myth. He argues that progress is fundamentally evolutionary. It's driven by decentralized experimentation, really messy trial and error, and this is the absolute key to the whole thing, feedback loops.
Feedback loops, meaning the organism has to actually feel the consequences of what it does.
Exactly. If a lizard makes a bad jump, it falls and gets eaten. Immediate, fatal feedback. Now, apply that biological reality to the standard stock market model. Does a massive market cap-weighted corporation always feel the consequences of a bad decision right away?
I mean, eventually? Maybe. But I see your point. If you're a trillion-dollar company, you have a massive cushion.
You have an enormous cushion. And the index itself actually makes this worse. Market cap indices allocate capital based entirely on past success. They basically say, you became a giant yesterday, therefore you deserve more money today.
It's blindly feeding the dinosaur just because it's the biggest thing in the room, without even asking if the dinosaur is adapted to the current climate.
Precisely. And in biology, assuming the current apex predator will just stay on top forever is a fatal assumption. Environmental conditions change.
So we are pouring our savings into the thing that has already won, just implicitly assuming it's going to keep winning.
Yes. But the alternative model, the inside ownership model, changes the metric entirely. Instead of the market asking, how big are you? It asks, how much do you have to lose?
So this is the skin in the game concept.
It is. But we need to be really specific about what that means here, because skin in the game gets thrown around as a corporate buzzword constantly.
Yeah, every manager claims they have skin in the game.
Right, but the research compares two very different types of leaders to two very different types of animals. You have the hired steward, the professional CEO, and they are compared to a zoo animal.
A zoo animal. That seems a little harsh for a guy with an MBA in a corner office.
Well, it's a metaphor for the environment they inhabit. Look at their incentives. A zoo animal gets fed regardless of whether it successfully hunts that day.
Oh, sure.
A professional manager gets their base salary, their stock options, and very often a golden parachute.
Huh.
Even if the stock drops 20% and thousands of people get laid off.
They are completely insulated from the raw environment. They might get fired eventually, but they definitely aren't going to starve.
Exactly. The feedback loop is incredibly weak. Now, you compare that to the founder-owner. The research calls them the wild animal. They are out in the jungle every single day.
Because their entire net worth is tied up in the company.
Right. If they make a bad decision, if they misallocate capital or ignore a new competitor, they don't just miss a year-end bonus. Their fortune evaporates. They feel the pain immediately.
Okay, that's a really powerful image. But I have to ask, does that fear actually change how they run the company? Or does it just create a bunch of stressed out executives? Because I can imagine a terrified wild animal making some pretty erratic bad decisions too.
It's a fair question, but the data suggests it fundamentally alters the metabolism of the entire organization. And this brings us to the second major part of our dive, which the source material calls the pain principle.
The pain principle, that sounds intense.
It's the raw engine of evolution. Ridley is very clear on this rule. Bad ideas must die so that good ones can spread.
Right.
In the wild, a bad strategy physically kills the animal. But in a massive corporation where the management owns practically zero stock, bad ideas act like zombies. They just linger.
Why do they linger? Why doesn't the board just kill the bad idea?
Because the pain isn't sharp enough to force a quick correction. Let's just play out a really common scenario. Say a hired CEO wants to execute a massive corporate acquisition.
Okay.
Maybe it's a flashy, incredibly expensive deal that doesn't actually make much strategic sense, but it instantly doubles the sheer size of the company.
And for that CEO, doubling the company means a bigger office, a cover story in a business magazine, and probably a huge raise because they are now managing twice as many assets.
Exactly. The CEO personally wins, even if the shareholders ultimately lose out on the deal. That is the classic agency problem. The agent's interests simply aren't aligned with yours.
But now, imagine that exact same scenario with a founder who owns, say, 30% of the company.
Right. If they spend $1 billion on a terrible idea, they are personally lighting $300 million of their own money on fire.
They aren't going to do that just for a magazine cover.
Never. They are only going to pull the trigger if they are absolutely certain that new asset will survive in the wild. And this actually leads into a mechanism that I think is the most crucial part of this entire deep dive, even though it usually gets overlooked. It's all about dilution.
Dilution. Okay, that is one of those finance terms that people always nod at but maybe don't fully grasp. Let's unpack that.
Let's break it down simply. Imagine you and I start a pizza shop. You own 50% of the pizza. I own 50%.
So delicious.
We have a nice, profitable little business. But then I decide I want to expand rapidly. I want to buy 5 brand new ovens. But we don't have the cash on hand. So I bring in an outside investor and I give them a chunk of the company in exchange for the money to buy the ovens.
Okay, but to give them that chunk, our slice of the pizza gets smaller.
Exactly. Maybe now you only own 30%. That is dilution. Now, if I'm a hired manager and I don't actually own any of the pizza myself, I don't care about dilution at all. I will issue new stock all day long to buy those ovens because it makes the whole operation look bigger under my watch.
But if you're a founder?
I hate dilution. I despise it.
Because you are literally shrinking your ownership of your life's work.
It is incredibly painful. A true founder treats their equity like physical gold. They only issue stock. They only dilute themselves if they are mathematically convinced the return on those new ovens is going to be massive. If it's not, they just won't do it.
So this connects directly back to Wall Street's obsession with growth. The market loves growth at all costs. But you're saying there's good growth and bad growth.
Ridley makes a brilliant distinction here between growth and fitness. Think about it biologically. You can get fat without getting fit.
Sure.
In business, you can grow your revenue by selling dollar bills for 90 cents. That absolutely shows up as revenue growth on a quarterly spreadsheet.
But the organism is actually getting weaker underneath.
Correct. Inside ownership indices naturally tend to filter out that fat, unproductive growth because the owners flat out refuse to dilute themselves for low-quality expansion. They are naturally much more conservative with capital, but, and here's the real paradox of the whole model, they're actually more aggressive with innovation.
But conservative with money, but aggressive with ideas.
Exactly. They take far fewer stupid financial risks, which gives them the stability to take much bigger existential risks on new products and technologies.
Okay, I want to challenge this whole founder's God idea for a second, because just because someone founded a company doesn't automatically mean they're a genius.
Oh, absolutely not.
Right. I mean, we've all seen founders who refuse to let go, who micromanage everyone, who just drive the thing straight into the ground. Why does the wild animal actually make better decisions than a seasoned, rational professional?
That is a very fair pushback. Not every founder is great, and many fail. But the system of inside ownership solves what Ridley calls the knowledge problem.
The knowledge problem. Let's get
Yeah.
into that.
It's a deep critique of top-down central planning. We tend to think the CEO up in the corner office sees everything clearly, like a four-star general standing on a hill surveying the entire battlefield.
Sure. They have the data dashboards, the quarterly reports, the highly paid consultants giving them summaries.
But Ridley argues that real actionable knowledge is actually dispersed. It's out on the edges, it's on the ground. The person running the factory machine knows it's going to break 3 weeks before the maintenance report ever hits the CEO's desk.
But in a massive, bureaucratic, market cap-weighted company, that knowledge has to travel through, what, 10 layers of middle management?
It's a corporate game of telephone. By the time the CEO finally hears it, the message has been smoothed over to say, hey, everything is fine.
Right. But founder-led companies bypass that.
They often short-circuit it entirely because the person making the massive capital allocation decisions is very often the exact same person who built the original product. They possess what Ridley calls tacit knowledge.
Tacit knowledge. What does that look like in practice?
It's the kind of knowledge you can't just write down in an employee manual. It's the intuitive feel of the product, the specific, unarticulated understanding of what your customers actually hate.
Wow.
A hired CEO flown in from a management consulting firm can read all the market reports they want, but they don't have that tacit feel in their bones.
It's basically the difference between reading a textbook on how to swim and actually jumping into the ocean and getting wet.
Exactly. And that getting wet advantage allows them to adapt incredibly fast. Ridley makes this great point that markets aren't these magical truth machines that are always right in real time. They are discovery processes.
Meaning they have to figure it out as they go.
Right. They do correct errors eventually, but usually they correct them violently and very late.
Like the 2008 financial crash. I mean, everything looked totally fine and logical on paper until suddenly the whole house of cards just collapsed overnight.
That is the perfect example. The market was functionally wrong for years, and then it corrected all at once in a bloodbath. An owner-operator doesn't wait for their stock price to crash to know something is fundamentally wrong. They feel the vibration on the factory floor. They can pivot long before the market wakes up and punishes them.
Okay, so the biological theory is really sound. The wild animal is faster, it's leaner, and it feels the pain of its mistakes. But I'm going to throw a massive wrench in the gears here.
Go for it.
If I look back at the history of the stock market, let's look at the 20th century. Companies like AT&T, General Electric, IBM,
Your titans.
these were big, fat, incredibly bureaucratic zoos. And they didn't just survive, they dominated the globe for 50 straight years. Doesn't that historical record prove that size actually does win in the end?
It's a really great counterpoint, and for a long time, it absolutely looked like size was the ultimate unbeatable mode. If you were big enough, you simply couldn't be killed. But Ridley gives us a history lesson here that completely changes how you have to interpret those old monopolies.
Oh, so what are we missing?
He argues that historically, those massive dynasties weren't actually sustained by innovation or evolutionary fitness. They were sustained by politics.
Politics. I thought GE won because they just had the best light bulbs and the best jet engines.
Early on, absolutely, they innovated to get big. But look at AT&T. For most of the 20th century, they weren't just big. They were a legally enforced monopoly.
Okay.
The government literally banned competition because they believed the national phone system was what they called a natural monopoly. So AT&T didn't have to act like a wild animal. They didn't have to constantly hunt. They had a cage built of federal laws that kept all the predators out.
So they didn't survive because they were the most fit organism. They survived because the referee actively rigged the game in their favor.
Correct. And notice what happened to actual innovation during that massive stretch of time. Did the public internet come from inside AT&T? Did the mobile phone revolution come from the center of that monopoly?
No, not at all.
No. Innovation completely stagnated because the evolutionary pressure was turned off. It was only when the regulations finally broke down, when the government opened the cage, that the real wild animal innovation exploded in the telecom sector.
So the big lesson there is, don't mistake a government-protected castle for a naturally strong, adaptable business.
Exactly. But this leads us to the most critical question for anyone investing today. Look at the modern tech giants. The Magnificent Seven, Google, Meta, Amazon, they are unimaginably huge. Are they just the new AT&T?
That is the trillion-dollar question right there, because they certainly feel invincible to us right now.
Ridley says no, they are not. This is what the research calls the new model of monopoly, and it is actually significantly more fragile than the old industrial model.
Fragile. Google feels like the absolute least fragile thing on planet Earth.
They are completely dominant today, yes. But think about what their dominance is actually built on. AT&T had physical telephone poles and literal copper wires running into every single house in America. That is a hard physical barrier to entry. You can't replicate that easily.
Right, I can't just go lay my own copper wire across the country.
But Google, Facebook, their dominance is based purely on information advantages. Things like proprietary data, network effects, search algorithms.
But isn't that a massive moat in itself?
It is, but it's a moat that can evaporate overnight. Information advantages decay incredibly fast. If Google stops innovating on their AI capabilities for even 6 months, users can switch to a competitor instantly. There's absolutely no physical copper wire tethering you to Google search.
So unlike AT&T, they can't just sit back for a decade and count the cash.
They are running full speed on a treadmill. They have to keep acting exactly like wild animals, even though they are massive giants. If they stop experimenting, if they lose that founder mentality, the feedback loop from the modern market will kill them much, much faster than it ever killed the old industrial giants.
Which brings us right back to the power of inside ownership. You're saying that in the hyper-fast digital age, this raw founder mentality is even more critical than it was in the past.
Absolutely. The modern environment is far more volatile. The evolutionary pressure is higher than ever, so you need a leadership structure that is hypersensitive to rapid change, a structure where the leaders feel the pain of a misstep immediately.
Okay, so let's zoom out to the 30,000-foot view for a minute. We have this really compelling biological argument for inside ownership. But then I look at where the actual money in the economy is going right now. Trillions and trillions of dollars are pouring blindly into passive index funds. The S&P 500, total market funds. Everyone is just blindly buying the zoo. What does that do to the whole ecosystem?
It creates a massive systemic inefficiency. The source material refers to this danger as path dependence.
Okay, stop right there. Path dependence. That's a bit academic. Break that down for me in real terms.
Sure. Think of a muddy dirt road out in the country during a rainstorm. The very first car drives through and leaves a deep rut in the mud. The second car comes along, and just to be safe, the driver steers their tires right into that exact same rut. Makes sense. By the time the 100th car comes along, the rut is so incredibly deep, you literally cannot drive anywhere else. You are physically locked into the path.
Even if that rut is eventually heading straight off a cliff.
Exactly. The path forward is entirely determined by what happened in the past, not by what's actually best for the future. And the market cap weighted index is the mother of all financial ruts.
Because the money just flows in automatically, regardless of fitness.
As trillions flow into these passive strategies every month, that capital isn't out there looking for the best future ideas. It's not hunting for adaptation. It's just flowing to whoever happened to be big yesterday. It blindly reinforces the past.
It's autopilot investing.
It's actually worse than autopilot. It's capital allocation completely divorced from incentives. You are systematically shifting the world's wealth to legacy winners, regardless of their current biological fitness. You are feeding the dinosaur just because it was big yesterday.
So if I'm buying the standard S&P 500, I'm basically just buying a history book.
That is the perfect way to frame it. Market cap indices tell you exactly who won the last war. Inside ownership indices are trying to tell you who actually has the weapons and the mindset to win the next war.
But we don't actually know who will win the next war. That's the real risk here, isn't it? If I bet on these founders, I'm taking a risk that they might just be entirely wrong.
You are taking a risk. And Ridley would be the first to say we cannot know the future. We can't predict if the next big economic leap is going to be AI or crypto or cold fusion or something we haven't even named yet. But we can bet on the system itself.
This system of aligned incentives.
Right. We are betting on the raw survival instinct. We are betting that a group of people with their entire personal fortunes on the line will figure out the future faster than a detached committee of hired managers playing with other people's money.
It's really a bet on human nature at its core.
It is. It's betting that skin in the game is the only form of gravity that keeps a massive company grounded in reality. When you strip that gravity away, companies tend to just float off into abstraction, endless bureaucracy, and eventually extinction.
So we've covered a ton of ground today. We've gone from desert lizards to corporate boardrooms, from the pizza slice theory of dilution to the AT&T monopoly cage. If the listener takes one single thing away from this deep dive, one thing to really chew on when they look at their own portfolio, what should it be?
I'd say it's a profound call for humility. We spend so much time watching financial news, trying to pick the ultimate best stock, trying to brilliantly predict the future. But Ridley's work shows us that the world is simply too complex and chaotic to predict. Instead of trying to be a fortune teller, look at the structural incentives of where you put your money.
Stop obsessing over the predictions and start looking at the people left holding the bag.
Exactly. Are the people running the company betting their own livelihood on the final outcome? If they aren't, why should you?
I want to leave you, the listener, with a thought from the notes that really stuck with me as we were putting this together. It sums this up perfectly. When you look at your portfolio today, ask yourself, is this built on a system that rewards constant adaptation? Or are you just buying tickets to a museum of past successes?
A museum of past successes, that is a really haunting thought for an investor.
It definitely makes you look at that monthly 401k statement in a completely different light. And perhaps it's a reminder that nature never stops testing us no matter how big we get. Thanks for taking the plunge with us on this deep dive.
Always a pleasure.
We'll see you all next time.